Welcome everybody to Stock Talk with Nico Criticos. Today we're going to be doing a stock analysis on Intuit stock, but this is not financial advice, so just keep that in mind. This is purely for informational purposes. This is just some research that I did and some fundamental analysis. So if we get started with this, Intuit is not a stock that I've owned, but it's definitely one that I'm interested in because of all the strong companies that they own. So I guess the main thing they do is I put them in the financial sector. They have different streams of revenue though. They own TurboTax, they own QuickBooks, they own Mint, they own Credit Karma, and they own MailChimp. Those are some of their biggest streams of revenue. TurboTax has a 73% market share in as far as the tax business. And so that's huge. That's almost a monopoly in that business. Most people do use a lot of people use TurboTax. Then we have QuickBooks, and this is for small to medium-sized businesses. They have 29 million businesses using QuickBooks, and this is about an 80% market share, which is also incredible. And then we have Mint, which is it's an app. It's a finance app for just people's personal finances. We have Credit Karma that has to do with using people's credit scores to show them things. And then we have MailChimp, which is a automated email marketing type of business. So that's all the different companies they own. And if we look at the stock price action here, we can see that I would be very interested in buying this stock if I actually had some more money, but I spent a lot of my money on stocks, so I don't have much left. But this stock peaked out last November at about $716. Today it's $480, so it's come down a lot. And that brings us to our first part of the checklist, which is the stock down? And I put yes, because it's down over 35% from its highs. So that's going to get a check because that's what we want. We want to buy low, sell high. Then if we take a look at revenue and income, we can see that this is a company, and keep in mind, this is a company that's at a $136 billion valuation. Just keep that in mind. And this company in 2021 did $9.6 billion in revenue and $2 billion of net income, which is fantastic. And from 2015, they were doing 4.1 billion in revenue, and now they more than doubled their revenue in the last 6 or 7 years, which is great. And then net income has gone from under $1 billion to over $2 billion now. So both of those are definitely going to get a check. Then we get to the price to sales and price to earnings metrics. And this company trades at a forward PE of 39. Okay. And that's with 21% growth of EPS year over year, right? So from my perspective, that does not seem too bad. This company in the past has traded much higher at a 55 forward PE. So a 39 or a 40 does not look too bad, especially for a company growing EPS that much. And then if we look at the price to sales, it has a price to sales of 11 with 28% revenue growth, 28% revenue growth expected for 2022. And that's another metric that makes it look pretty fairly valued or undervalued, actually. So in other words, this company is expected to do, and see, in the past, it's traded up. See, 6 months ago, it was trading at a price to sales of over 17, but a price to sales of 11 now is not that bad considering they're going to do roughly 28% revenue growth this year. So that revenue growth is expected to slow down a little bit next year and come down to 15%, but they're going to be doing, they should do about $12 billion of revenue for this year. And then if we keep moving, we can see, is the company innovative? Do they have a moat? I put yes. I think they are very innovative. They've acquired all these different companies. They come out with different software, different apps, different ways to help people do things more efficiently. They help small businesses run the business, and they help people be able to do their taxes easier. So I think that's nice. And then as far as a moat, we've seen, I showed you how much market share they have. They have 70-80% market share in some of their businesses, which is pretty much like a monopoly. They pretty much own the whole thing. And so that's definitely going to give them a moat because they have so many different customers. And is this a growing industry? I put yes, I think absolutely it is. As far as, you know, people needing to do their taxes in an easier way. And there's always going to be more people coming back to do their taxes through the software. And I mean, there's always going to be more and more businesses that QuickBooks can sell to and different services they can offer to help out the businesses. And then we get to return on invested capital. And let's see, based off of what this is saying they have return on invested capital of 56%. Now it's probably not always that high because that's a very high number. But if we go back and look at, like, for example, so remember they did 9 billion in revenue this year, 2 billion in profit, right? And if we go back to a year ago, when they started out 2021, they had, what is that? So 8.8 billion in equity, but they had 2.7 billion of cash, right? So a little over a year ago, they had 2.7 billion in cash. And throughout 2021, they ended up they did $2 billion of profit and 9 billion of revenue. So that's huge. With only 2 billion on the balance sheet, that's a lot of money to make from just that 2 billion. And so that's definitely going to get a check. Then we get to margins. This might be, I don't know if I know any other businesses that has a gross margin this high. This is out of all the stocks that I do analysis on, this might be the highest one because a gross margin of 82% is very hard to come by. That's very rare. So that's a great number. And so is that profit margin of 19%. That's very high too. So that's why they're able to make so much money. Healthy cash flow, I put yes, because I'll show you the numbers. They are investing heavily back into the business, but I think it's in a justified way because they are making tons of money, but I think they're doing it in a healthy way. So we have operating cash flow of 3.1 billion for the past year, right? And they invested they invested a lot more than that. They invested 5 billion. But if you go back and look at the past couple of years, you can see operating cash flow was, floating around this $2 to $3 billion, right? But they were investing way less back then. So 2019, 2020, they invested this is 97 million right there. So that's nothing. And that's why if you look at that end cash position, you can see it had gotten up to $6.6 billion. And then it was down to 2.8. And I think that's why they spent so much money in 2021. They invested that 4 billion because they had 6.6 billion on the balance sheet. So that doesn't look too bad. End cash position, it's come down a lot, but that's really just because of the investing that they're doing. And the financing, so they financed, it looks like they financed a lot in 2021, right? They took out $3 billion, came out, 1.4 came back in over the past 12 months. And then if we look at free cash flow, it looks strong. It's been around this $3 billion mark for the last couple of years. So for the past year and a half, it's been $3 billion. So that looks good to me. I mean, this is a company that pulls in lots of cash. It's a high margin business and they're investing back into the business where they're buying out new companies. So that's good. And the balance sheet looks good and everything. So I can't complain. And then next up, we have diverse revenue streams. Yes. Not only, just like how I said earlier, they have several of those different businesses for different revenue streams. But they also think about all the different customers they have. They have over 120 million customers. And so it's definitely a diversified business model. Then we get to the balance sheet. I changed this a little bit. I used to divide this one into short-term and long-term assets, but I just wanted to keep it into one. I figured one was enough. And most of the time, most companies have both, or they either have both, and the ones who don't, they normally have neither. So I think this is a more fair way to do it. And I replaced it with this price to book one instead. But they do have more assets and liabilities. And then if we look, this is the new one I'm experimenting with. I'm not sure if I'm going to keep this, but this is something I kind of want to incorporate into this just to keep it in mind. And that's a low So this is going to be a price to book ratio divided by the equity growth they've had over the past 12 months. So in this case, this company trades at a price to book of 8. Okay. Price to book of 8. And they had 75% growth over the past year. Okay. Which comes out to a 0.1. Now the way I'm looking at this is, so we remember that they financed, I think, $3 billion. Let's see. They financed 2021 over $3 billion came out, right? So they financed a lot. They invested back into the business, and that's probably why their equity went up so much. And then the prices come down a lot. The price to book used to be higher, but now we're at 8, and 75% equity growth is huge. That's a lot. Their equity went from, I want to say, what was it? 8. I think we said 8 billion at the beginning of the year, 2021. Let's see. So it's gone from 8.8 billion in the beginning of 2021 to almost 16 billion. That's 75% growth. That's huge. That's over $6 billion of equity added to it, right? So that's good. Then next up we have, does it have a high equity relative to the market cap? I put yes. It's not huge. This is not a great number. This is just good enough. It's healthy enough. So this is how we said $15 billion of equity for 130. Well, now it's 135, right? Because now it's 136 because the stock was up almost 5% today. So now this is more like that. And so now this number is probably more like that. And so, so 11% of the market cap as the equity is not bad. There's definitely better out there, a lot better. But it's not, I don't know, it's in the middle. It's not bad, but it's not great. Then we have, is the equity increasing? Yes, it is. And then we have, do they have a strong share buyback program, or do they have a dividend? And yes, they have both. Healthy dividend, not a huge dividend. It's only it's a 0.5%. Okay, that's not that great, but they do pay a dividend. And the share buyback program, I think they said, I want to say they had $1 billion of share buyback in 2021. Keep in mind that's adding under a 1% gain to the stock, but I think they said they're going to do around I think they're adding 2 billion. So I think another $2 billion of share buyback should be coming this year, which will be a little bit over. It'll be 1.5% or something like that added to the stock. So it's still a good sign. But the problem is, here's the issue. So we have profit margin of 19%, but the issue here is that the share change year over year was actually 4.8%. So even though they're buying back shares, they must be doing more stock-based compensation that is offsetting that buyback program, and they're diluting shareholders just by a little bit. So for a company like this is not a it's not like this is a small unprofitable company though. This is a mature company with huge cash flow and fantastic profitability. So it's not like I don't see this company going out there and taking on a bunch of debt and issuing more shares and hiring a bunch of people. I don't see that happening. So I think this might be a one-time thing or a temporary thing or something that is going to easily be offset and headed into the right direction. Because I do think Intuit is a stock that will continue to go up. If you look at the last 5 years, there's not many stocks that do this. It's very hard to find stocks like Intuit or like Nvidia or like Google, where these stocks will just, for years on end, they'll just keep going up and up and up, and they don't ever have too big of crashes. So look at Intuit. Intuit, let's say you were waiting for a dip for this stock. 5 years ago, it was $117, right? Then in 2018, it hit 230, right? Let's say it. Then by the end of 2018, it came down to 185. So I guess that's a lot. That's a decent size. I mean, from 230 to 180, though, that's not a huge dip. That's not that big of a dip. Then, of course, in the COVID pandemic, we had it go from $300 to $200, which is that's a decent sized dip, right? What is it? That's a 33% move. That's not even that big compared to some of the other stocks that fell 60 or 70%, but that was a one-time thing. You're not normally going to get that. And then since then, it's had this huge run from $200 all the way up to $700. So it's hard to find this stock it's hard to find this stock to dip. And now we finally have a pretty significant dip. This might be the biggest percent drop it's had in the last, who knows, over 5 years, maybe 8 years or 10 years. So, I mean, this looks like a decent buying opportunity. But yeah, I think this company continues to keep growing and growing, and everything is strong. I don't really see much wrong with it. I don't think they even, let's see, they didn't miss one thing on my checklist. So we could put this as a yes too, even though I still need to compare this to other stocks, which I'm doing too. But I guess the only one that's going to get a no is number 17. But the rest of these, this is going to get a score of 17 out of 18, right? Then we have, is insiders or big money buying? I put no. As you can see here, there's been a couple buys. There was a decent amount of buying in December 2021. But besides and there was a lot of buying last year. So I guess that's good. But it looks like there's this for how much the stock has fallen the last let's say 2 months, there's not a lot of buying pressure out there. So I'm not sure. Maybe all the insiders made their positions right here in this $540 range, and maybe that's why they're not buying now. But I mean, I don't know. It's kind of, I'm not sure. I don't know why that's happening. Then we have, if you look at what hedge funds are doing, we could look here and we can see that let's see. Intuit. So here's what funds holding. So funds holding is up, right? So that's good. Of course, hedge funds are going to own this. Let's see. Change in shares. So these companies were selling anywhere from 300,000 to over 1.2 million shares. But look at the buying pressure. It's way more. 3.8 million, 2 million. BlackRock bought 1.6. So there's definitely some buying pressure. I guess we could put a yes for that, even though insiders aren't buying, the big money's buying. And then finally we have, how's the management team? It's great. I mean, look at everything this business has done. All the signs point to a great management team. You don't get results like this with a bad management team. So this might be one of the, I think this might be one of the only stocks. I know Alibaba got a high score on my list, but this might be the highest I've seen. There's not many companies I come across that score perfect on this list. So this is an 18 out of 18. I would absolutely consider this stock a buy right now. Absolutely consider it a buy, but I'm not a financial advisor. This is not financial advice, just my opinion. So yeah, that is a wrap for today. And yeah, if you guys have any questions, comment down below. Comment down below what your thoughts are. What do you think about this stock? And let me know if there's another stock you want me to do a breakdown on. But yeah, thank you for watching, and I will see you guys in the next video.